Hey, what's going on? JP Albano here. In this video, I want to share with you a conversation that I had recently with an investor. And I think it highlights, just a really good talking point. It's sort of this breaking down maybe a misunderstanding or a belief about how maybe investing personally into a smaller apartment complex is less risky than being part of a much larger investment in a larger property, right? And I'll give you the background here. So first, table stakes, let me explain what we do, because I think part of the problem for this investor was not really understanding what it is that we do. So first, what we do at a very high level is we buy older apartment complexes in growth markets, places where there's a lot of good things going on. And we do a bunch of work in the apartments to increase the value, to increase the profitability. That's sort of really it. Buy low, sell high. That's sort of it. And then my company operates these deals. We raise money from investors, generally tech sales investors, but really could be anybody. And those investors, they're silent investors, they're silent partners, they're passive investors. They put money in, that's their only work they do, right? And then at the end of the project, they get their money back plus returns. That's basically it. And then our company, my team at my company, are the ones that are operating the deal and doing all the day-to-day, dealing with tenants, toilets, and trash, okay? So this gentleman, Bob, his understanding was, well, I don't know why I would want to be part of kind of a crowdfunding in an apartment complex when I could just buy it myself. And absolutely, sure, you could absolutely buy an apartment yourself. The thing, though, is what we're offering is passive income for passive investments. So if you're in sales or any job, you have a day job. You're doing that thing full time. You can make money, of course, buying a duplex or buying a quad up the street, but is it less risky than putting in 50 or 100 grand into a deal and being part of a larger project? And that was the idea. That was this belief that this gentleman has, is that by buying the project myself, I get, more of the returns. The truth is the returns are virtually identical. Buying a quad versus buying a 200 unit apartment complex, from a return percentage standpoint, they're roughly about the same. Call it between 12 and 18%, 20%. That's usually the average target, is you're getting to 20%. So if you're still going to make 20% at the end of the day, but one of the projects require you to do a crap ton of work, and I'll get into the work here in a second, versus the other one where you don't have to do anything, which one is a better investment? In my opinion, it's the one where you're not doing any work, the one where you're not trading time for money, because that's what you're doing right now. When you have a day job, you're trading time for money. When you buy an investment, a quad, apartment complex, and I don't want to poo-poo quads. It's a great idea. I wish I can go back in time and make my first house that I bought a quad. I'd house hack the crap out of that thing. But like when you're buying this apartment complex and you have a full-time job and your idea is, well, I'm going to save money, I'm going to manage it myself, I'm going to do all the work myself, collect the rent myself, do the repairs myself. Guess what you just did? You created a second job, right? And that defeats the purpose. So if that's what you want to do, that's really cool. But I want to get into some of the details here on, I think, what gets lost in translation on what you're really missing. This kind of idea that, well, it's more risky. So number one, we're comparing like a quad to a 200 unit apartment complex, and that's the sort of sizes that we buy. A couple of things. One, complex. In a smaller apartment complex, how many people do you have to pay your mortgage, pay your rent? Well, if it's a quad, you've got 4 people. So what happens when one of those people loses their job? You have income now from 3. And what happens when the other one gets sick and loses their job? You've got 2. And I'm not going to keep going here, but you get the point here. So your break even occupancy, how many people you need to pay your rent is pretty tight here. You probably can't sustain more than 1, maybe 2 people before you're getting tight. And getting tight means that you, as the investor, need to dig into your pocket and pull out cash to go pay that mortgage if your renters aren't able to pay their rent on time each month. Where this becomes risk mitigated is when you have a larger complex. So 150 unit, 200 unit, you've got 200 people paying their rent every month. Even if 20% of them, 30% of them don't pay their rent, which is a tremendous number, by the way, right? And you've got some big problems if that many people aren't paying rent. You've got a lot more wiggle room, breathing room to be able to sustain having enough money coming in to service the mortgage, pay the debt, right? And that's a huge, huge risk, because when you're signing on the loan for your mortgage, for your property, whether it's a 4-unit or a larger property, you're signing on the loan. The difference, though, is on a larger property, you're able to take out what's called a non-recourse loan, a loan where The bank doesn't hold you personally responsible unless you're negligent or you're stealing from the property, right? There's called bad boy carve-outs. But on a smaller property, like a 4-unit or a duplex, you're probably taking a recourse loan. And so if you don't pay that mortgage, they're going after you, right? On the commercial side, it's the property is the asset. The asset is the collateral itself. So there's more risk on this part of the borrower who's borrowing to buy a 4-unit versus a 200 or being part of a 200-unit. That's kind of part one. Part two is the leverage is lower. So the amount of loan, the size of the loan that you'll be able to take out on a quad property is going to be less than what you would get on a larger property. And why that matters is because if you're looking at a return standpoint, if you're going to put in 100 grand into a deal, you're going to have to put more money. 100 grand isn't going to cut it for you. You have to put 4 times that amount or even more in order to buy that 4-unit property, right? So you're putting more cash in because you can't get enough leverage. And so your returns from a percentage standpoint are going to be less. So that doesn't make a lot of sense. The other piece too, going back to this idea of the whole point of making this investment is to be a passive investor, right? Not having a full-time job. Well, finding a property manager for these smaller properties, actually before I get into that, a smaller property doesn't have enough revenue. The rent that you generate each month isn't usually enough to support. Now, this goes out the window if your rent is $5 grand a month, right? If it's $5 grand a month in rent, different story. But for most average workforce housing where you're charging $1,000 a month, $1,400 a month, there's not enough money coming in to support an on-site staff to collect the rent, to provide service, do all the things, right? That only really comes into place when you have scale. Scale happens when you have more than 4 units, right? Obviously, I think about 100, 150 or so, which is really when the scale starts to kick in. You'll be able to have a property manager that's working there full time, maybe even a service manager, and the more units you get, the more team you'll be able to have. We have a 278 unit in a suburb of Cleveland, Ohio. We have a team of 12 people that work there. So it's not me running the property and answering the phones and collecting the rent and things like that. We have a team that we manage. And so that leads me to the next problem, which is finding a qualified third-party property manager for your small quad property is generally hard, right? Usually the people that are managing those properties are people that are managing third-party managers for single-family rentals. I have a whole beef with single-family rentals. We can talk about that another time. But generally people that will, at that scale, that are willing to take on managing a small property, a small multifamily like that, are single-family property managers. In my experience, and I don't want to poo-poo all of them, my experience, they just don't really know how to manage a small multifamily property. It's going to be very expensive because they're not set up for that. And so it's going to be harder. And so what that means is you, as an investor, you'll probably be limited to investing in a city that's close to where you live. The problem with that is, one of the reasons that we love multifamily so much is we invest in high growth markets, places that have population growth. If that isn't in my backyard, well then crap, I'm stuck in investing in a place that maybe isn't a high growth market. Maybe it's a low growth market. Maybe it's a no growth market, or worse, maybe it's a negative growth market. And what that means is your potential renter pool is getting smaller and smaller and smaller each year. So if you want to talk about apartments or real estate being risky, it's really making these decisions that put you in a bad spot for failure, not for success, right? That's kind of really it. And so we got less scale, no ability to bring on an on-site team, recourse loan, you're going to put more money in the deal versus the alternative here, which would be investing in a larger property where, yes, you're not doing the day-to-day and you might have a sense of lack of control, but at what expense, right? The expense of being the guy to go fix the toilets and deal with the trash and collect the rents to make probably the same, maybe even a worse return. I don't know. It doesn't add up to me. And so if nothing else, Bob, you've gave me a great talking point to share with people. If you found that to be useful, do me a favor and go ahead and give me a subscribe. See you next time.